Johnson & Johnson is one of the world's biggest healthcare companies, with divisions that specialize in over-the-counter consumer products, prescription pharmaceuticals, and medical devices and diagnostic equipment. Now, I own shares of J&J both personally and in my Strategy Lab model dividend portfolio, which you can view at the web address on your screen. As you can see from this stock chart, J&J has had a rough ride lately. It's dropped from a high of about $108 last November to its current price of about $94. That's down about 13%. But I'm definitely not giving up on J&J. Even though the company's hit a rough patch recently, in part because of a strong US dollar, I consider J&J a core holding for several reasons. Reason number one, J&J is a dividend growth machine. The company has raised its dividend for 53 consecutive years, and I fully expect that trend to continue. And because the stock price has dropped, the yield has risen to an attractive 3.2%. Reason number two, the stock is attractively valued. J&J's price-to-earnings multiple, based on estimated 2015 earnings, is about 15.3. That's down from its 3-year average of 16.1 and less than the S&P 500's PE of 16.8. Reason number three, the company has demographics on its side. As baby boomers get older, they use more prescription drugs and use more healthcare services. That provides a tailwind for J&J. It's also worth noting that J&J has a strong product pipeline with new drugs in areas such as cardiovascular, oncology, immunology, and vaccines. With the Canadian dollar sitting at about 75 cents US, I'm not sure this is the best time to be adding to my J&J position. But if the loonie strengthens, I would consider buying more of this great healthcare stock.